Well, thank you, Andrew, very much for your introduction and for having invited me to be here. It's a great pleasure for me to address this forum, which I have followed some of the previous similar events. And let me start. It's also a pleasure, of course, to be with such a distinguished panel. At the same time, to discuss the euro at 30 with an interrogation point. And let me start without any arrogance to say that I would eliminate the interrogation sign, because I do think that the euro will be around certainly in 10 years from now, although nothing is written, of course, in history. And there are still challenges and changes that are necessary for the euro area will be to be more robust and assailable, growing, and so dispelling thoughts about redenomination risks or nationalistic, populist type of backlashes. So indeed, there is work to do. Some of the reforms that are needed are still part of a completion of what should have been the initial design of a monetary union. And the initial design was indeed too narrow. So as I said, the initial design was quite narrow, ignoring any mechanism to deal with liquidity crisis that can happen in any monetary union. And there are other shortcomings that in my farewell speech that you mentioned, I summed them up by saying that they were the result of a sort of practical convergence between Central European order liberalism and the anti-Keynesian new classic macroeconomics. Because indeed, the initial design was just to have a single currency and a fiscal break. And the thought was that this would be enough for a monetary union to work well. And the main points that were wrong behind that way of thinking were first the idea that monetary policy exclusively dedicated to inflation control is enough to ensure both economic and financial stability, and therefore dispensing fiscal or any other type of macroeconomic policy. The second was that the financial sector is not capable of generating fluctuations in the real economy, therefore dispensing with European-level supervision. And finally, the idea that only public debt can destabilize the system, whereas private debt could not, as the private sector economy is or would be self-equilibrating. Well, we know from historical evidence, particularly more recently, from the papers by Jorda, Schularik, and Taylor, that indeed most banking and financial crises were preceded by explosions of private debt. And the same was true in the case of the more recent financial crisis. So there was also, as I said, the problem of liquidity provision, both to banks and also interventions in financial markets, which was not dealt with in the initial design. But with time and the pressure of events, the ECB took that role, as it should, and now we have, I hope, a settled situation in terms of the legal competences and the duty of the ECB indeed to fight against liquidity squeezes that are not totally justified by any fundamentals, and we have had that during this period until finally the ECB intervened strongly, in particular with the famous sentence by President Draghi in 2012. And we all saw how it worked. So let's assume that is settled. So what now would be needed would be indeed the correction. Two things mostly. It's indeed the correction of the pro-cyclical bias of fiscal policy in general in the euro area, so macroeconomic management and financial stability issues, which are still to be solved. And we can describe them in these 4 items. So correction of the pro-cyclical fiscal policy bias at the euro area level via the revision of the Stability and Growth Pact. Well, the growth is perhaps there, but it is not about growth indeed. The creation of an European Stabilization Fund, the better coordination of national fiscal policies to build up an European fiscal stance. Completion of banking union, strengthening of the banking sector with EDIS, the financial backstop of the European Resolution Fund, and an European safe asset, which is essential to solve the so-called problem of concentration of banks' portfolios in domestic sovereign debt. The only way is to have an European safe asset. Third, creation of a capital markets union, which, again, the introduction of an European safe asset, and then strengthening also the macroprudential policy with the tools that are not at the disposal of macroprudential authorities and central banks. Among all these points, for me, the priorities are indeed the revision of the Stability Pact, the creation of an European Stabilization Fund, and the issuance of an European safe asset. Well, starting with the first, the correction of the bias. The bias is very well seen in this simple chart, which shows the development of the output gap in the US and in the euro area, and the development of the primary surplus, the structural primary surplus. And we see in Europe that in spite of the quite significant negative output gap, we started to have very early on very positive structural primary surplus, whereas in the US, they also had negative output gaps, but they also had very negative structural primary balances to accompany. So fiscal policy was much more expansionary in the US, and the inflation was more or less the same in the 2 regions, but unemployment was throughout much lower in the US as a result of this. So the bias is clear and results from the whole set of rules that exist in Europe. But in general, fiscal rules are indeed necessary to counter the deficit bias that has many motivations and that cannot be ignored. But in a monetary union, there are even further reasons to have some sort of fiscal rule. A good fiscal rule should take the externalities involved in a monetary union, and they are basically 2, which is a debt externality. If a country would face indeed the debt default, that sort of turmoil would have contagion in the whole region, so there is an externality there. And there is also a demand externality, which tends to be ignored in the design of the fiscal rule. So a good fiscal rule should take into account these 2 types of externalities and cater for 2 main goals. Control the deficit bias to avoid excess debt accumulation, and allow public finance to play a macroeconomic stabilization role. However, we know the mainstream consensus that has been even more crystallized with the emergence of the so-called new Keynesian DSG models, where monetary policy had the magic power to put the economy very easily just by changing the interest rate in whatever, in the good place of potential output and stable inflation. That consolidated this vision that for stabilization, macroeconomic stabilization, it would be just monetary policy that should do it, and fiscal policy was put aside for macroeconomic goals within the limits of prudent debt level, and perhaps allowing the automatic stabilizers to work. So the only admitted exception to this general principle was when monetary policy would be significantly constrained. But that, of course, happened in the monetary union, because at national level there was no monetary policy. So the initial version put forward by many of those who were involved in the creation of monetary union was that, of course, fiscal policy at national level should play a role of shock absorber. But in the end, the fiscal rule that was approved for the whole euro area leaves very small room for that role of fiscal policy at national level being a real shock absorber and playing a role in stabilization policy. And monetary policy is also constrained in certain general situations, which is, in the short term, what happens. Indeed, the extraordinary measures that had to be taken by the ECB and other major central banks now created a situation where the margin of maneuver of monetary policy is very limited right now. Let me go briefly through the different channels of transmission of monetary policy. So the interest rate channel shows, of course, diminishing results, as interest rates along all maturities are already now quite low. The expectation channel cannot by itself significantly move the economy. Economic agents want to see what are the instruments that the central banks would have indeed to keep for instance, adopting, as it is being discussed in the US, a price level path target, and then expectations would put by themselves inflation upwards. It won't work. The expectation channel is weak, and that also weakens forward guidance as an instrument, which was helpful once or twice throughout this period, but cannot work in a very significant way with a weak expectations channel. The channel of the exchange rates is a risky one because it can lead easily to situations of currency wars where everyone in the end loses. And conventional monetary policy was indeed effective and to mitigate the crisis and to start a recovery. So QE was valuable. It still works, but also, again, obviously, with diminishing returns. And finally, negative policy rates have now been used in Europe, in my view, to their limits. And further, they should not go down further as they create financial instability and can reverse their expansionary effect. Why? Well, it affects banks' profitability, then it can affect credit supply, then it can foster asset price bubbles, it can create zombie firms protected by very low interest rates, and in the end, there is also a political economy problem, because if they would go down more and more, at a certain point in time, the banks would have either to be very heavily subsidized by the state, or would have to reflect those rates into negative retail deposit rates, with the political backlash that would provoke everywhere. So there are well-known American economists that continue to theorize that more and more lower negative interest rates will do the trick, because they don't want fiscal policy, so they insist on more and more negative rates. But indeed, there are limits, and I think in Europe we have gone to the limits. And so all these points to question the conventional belief, division of labor between monetary policy and fiscal policy at the moment where we face possible recessionary phase. And that is reality, that monetary policy has limits, has been recognized even by central bankers like Ben Bernanke in 2003 in his speech in Tokyo about the economy of Japan, and the temporary monetary financing that he recommended that the Bank of Japan should do to public expenditures. Last August, we all had, I think, the surprise of seeing the Stanley Fischer, Philip Hildebrand, and Jean Boivin, three very well-known former central bankers, come up with a even more structured and formalized proposal than the one by Bernanke, by saying that in this situation, indeed, treasuries should prepare packages of measures of fiscal stimulus, and the central banks should then be managing those measures by choosing the timing and the amounts to be used from those packages of measures. This is a very significant proposal by these three persons who are quite well known for their knowledge and experience in macroeconomic management and central banking indeed. So an alternative approach is relating in the end to QE. Michael Woodford in 2012 in his speech in Jackson Hole proposed what should be done is that the Treasury would expand fiscal policy, but then the central bank, through enlarged open market operations, should administer interest rates to ensure that nominal GDP target, which he adopts, would be met, or if not, if it was not possible to meet it, then to keep interest rates at zero or very low. Another version is helicopter money related to distributing money to the citizens, a very complex practical endeavor. I don't see how it could be really implemented in practice. And in the US, there are also, as we know, many discussions for a more expansionary fiscal policy around the ideas that I consider flawed of MMT. But it has a positive role in agitating the idea because there are some elements in MMT that I agree with, but not until the end of the message. So Europe is far away from all these discussions. When the next recession comes, we should, however, be aware that monetary policy is lacking the tools to confront it alone. Monetary policy has to continue, of course, to be very expansionary, as it is, but it's not enough. It cannot do more. So fiscal policy, if fiscal policy does not respond, we may face a new situation of crisis. The problem, however, it goes deeper because it's not only in the short term. If we think about the medium and long term, we face then the issue of secular stagnation in advanced economies. In either of the two forms of the secular stagnation analysis, either in terms of the demand side, the structural lack of demand, meaning a structural trend for populations to have propensities to save much higher than the propensities to real investment to occur, or from the supply side, the approach of Robert Gordon and his skepticism about the economic traction of recent technological innovations. Whatever the case, we see that over more than 30 years, interest rates have gone down. Estimates of a controversial nature and concept of a natural or equilibrium interest rates also show this decline. And in this recent paper by Rachel and Summers, they analyze these numbers and also estimate what has been the impact in putting up rates of the budget deficits that occurred in many OECD countries during this period. And they estimate that these deficits to respond to the crisis contributed to an increase in rates of 400 basis points during this period, which means that what they call the pure private sector neutral rate would have declined since the beginning of the 70s by 700 basis points. This is quite structural. And by the way, it's not the fault of central banks that this has been happening in advanced economies. So secular stagnation also undermines monetary policy in the medium term, because if we believe that monetary policy should not use fully negative interest rates ever more negative, then this introduces limits to monetary policy. And so in our economies, if the private sector wants to save more than spend in real investment, three things happen. First, there is a current account surplus, which as a counterpart to investments abroad that may have lower returns than investments in the countries themselves. Second, interest rates tend to get lower because indeed means that propensity to save creates a lot of demand for safe assets. So interest rates, particularly of sovereign bonds, go down and down. And third, the state can go into deficit. This saving to offset the propensity of the private sector. And so the state should expand its deficits and increase its investments, as well as the supply of government bonds, of safe bonds. There is a huge shortage of safe bonds around in the world, and that puts down yields of sovereign bonds everywhere. So a fiscal stimulus would solve several problems at the same time. The current account surplus would be reduced, and being very high as it is in Europe, and particularly in some countries, it can lead to hostile reactions and retaliations in the present geopolitical situation. So, good reasons also for the return of fiscal policy. Suddenly this is not moving. The slide. Sorry? Okay. I'll try to sum up. I knew that I could not address all the problems. No, it's not moving the slide, I'm sorry. It was, but not now. Oh, it's here. Oh, perhaps not. Yes. Well, also the very low interest rates, fortunately, also open up a little bit of fiscal space in the present situation, and we all know the speech by Olivier Blanchard in April to the American Economic Association. And although he was cautioned and there are problems, we should not think that this dispels every limit. It does not. But nevertheless, it means that there is a little more space in the present situation. So turning to Europe then, and looking to our fiscal rule, well, the fiscal rule can be designed around norms for the debt, for the deficit, or the expenditure path, but not to be undone. We have all three in the European fiscal rule. And even the European Fiscal Board, in their assessment of the Stability Pact, they conclude that there are overlapping fiscal requirements that occasionally offer conflicting signals, a structural adjustment and a target for debt reduction, and policies are monitored using a multitude of indicators which inevitably cause conflicting signals. And indeed, this set of quantified targets mean that sometimes not even the automatic stabilizers are allowed to fully operate. So that's what we have. And so there are many proposals to change the situation, as we know. Some economists have despaired of finding a quantitative fiscal rule that can take care of all the contingencies. And Icahn Green and Viplox a few years ago proposed to renationalize fiscal policy in the euro area as a way to make governments responsible and, of course, facilitating a little more the market discipline of debt restructuring as a trade-off. But very recently, 2 weeks ago, Blanchard, Leandro, and Zettelmeier presented at Georgetown University conference just a set of slides of a very preliminary proposal that would also do away with all quantitative targets in the Stability Pact and would have just general standards or principles of good fiscal policy, and on that basis would give more discretionary power to the Commission, including the possibility of going to the European Court of Justice against countries that would not have a good behavior, which is also a radical change. But there are other proposals not so radical. I am not yet convinced of these more radical proposals to do away with everything. So my position is that we should change the Stability Pact in the direction of a good expenditure rule, and at the same time have a stabilization fund. Why? For two reasons. First, because an expenditure rule cannot deal with big economic shocks, cannot do it, and also because an expenditure rule cannot force a national government to use the fiscal space that they may have. So it's insufficient. So the stabilization fund is essential to respond to both asymmetric and symmetric shocks. And in what regards the stability fund, I agree with the IMF proposal of a rainy days fund with contributions of 0.35% a year or a little less could also work. So for the expenditure rule, these are the principles I would favor. It means that the net expenditures, of course, there would not be any automatic formulaic annual progression towards the long-term target of 60%. There would have to be, in calculating the expenditure growth pact, a broader DSA analysis and consideration of the economic situation, no automatism as it exists now in the convergence to a very long-term and controversial debt ratio, and also no more the concept of structural deficit, which is subject to so many revisions and creates so many problems. So the expenditure rule of this nature is indeed much less pro-cyclical than the set of rules we have now, and then the stabilization fund. So as I guessed at the beginning, I would have no time to talk about the third priority that I had, which is the issuance of a European safe asset. But I think it's a crucial reform at this juncture in Europe, because it caters for many necessary objectives. European safe asset is crucial to solve the problem of the concentration of portfolios of banks. There is no other solution, because all the other solutions would create turmoil and turbulence in national debt markets. The safe asset is, of course, crucial to create a capital markets union, to create a pan-European risk-free rate, a pan-European yield curve, which would help monetary policy, and, of course, would be crucial also to promote the international role of the euro. And finishing, then I would conclude that the present shortcomings around macroeconomic management and the financial stability framework have to be corrected. The role of fiscal policy and macroeconomic stabilization must be recognized with full reflection in a complete revamp of the Stability Pact and the creation of the Stabilization Fund, the creation of an European safe asset to promote capital markets union, the internationalization of the euro, and the stability of the banking sector is the third important and urgent reform towards a more robust European monetary union. Thank you.